Well, natural gas futures remain under pressure at mid-session Wednesday as a warm start to 2026 continues to erode heating demand. The mild weather has widened storage surpluses and revived speculation that inventories could once again exit the winter withdrawal season above 2,000 billion cubic feet, a level that would reinforce the broader bearish narrative. Earlier today, the U.S. Energy Information Administration, in its January short-term energy outlook, projected Henry Hub spot prices to average just under $3.50 in 2026, down roughly 2%, before rebounding sharply to just under $4.60 in 2027. According to the EIA, supply growth is expected to largely keep pace with demand in 2026, limiting upside. By 2027, however, they anticipate demand growth to outstrip supply, driven primarily by rising LNG feed gas requirements, which would tighten storage balances and lift prices. In total, the agency sees average prices falling 2% in 2026 before jumping 33% the following year. Meanwhile, weather forecasts failed to offer the bulls any meaningful support. While models do show frosty air pushing into the northern half of the U.S. late this week and into next weekend, with highs ranging from the zeros to 40s and lows dipping into the teens and 20s, this is being treated as routine winter weather. Demand is expected to strengthen from Thursday through Sunday, but the price action suggests these developments are already fully discounted. Notably absent from the forecasts are any signs of a polar vortex or a prolonged Arctic intrusion, conditions that would be needed to materially shift sentiment. Without that, the market is left guessing where professional sellers finally step aside. Looking ahead, Thursday's EIA storage report is expected to show an 89 billion cubic feet draw. Last week's report leaned bullish, with a 119 billion cubic feet withdrawal for the week ended January 2, above expectations of 109 billion cubic feet and well above the 5-year average draw of 92 billion cubic feet. Even so, inventories as of January 2 were only 3.5% below last year's levels and still 1% above the 5-year seasonal average, underscoring that supply remains more than adequate. At the current pace of withdrawals and with no sustained cold showing up in the forecasts, the storage trajectory is turning increasingly bearish into the end of January, raising the risk that surpluses expand rather than contract as winter progresses. From a technical standpoint, the market remains firmly in a downtrend based on the daily swing chart. The next downside targets are $3 and $2.80. On the upside, a move through $3.50 would shift the minor trend higher, opening the door to $3.60. Clearing that level could attract additional buying interest, with the 50-day moving average at $3.89 as the next major objective. That said, it's difficult to envision any sustained rally without a decisive break above the 200-day moving average around $4. Until that happens, rallies are likely to be sold into, keeping the market stuck in a classic sell-the-rally environment. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.